Interesting headline in the Journal. I want your take on, Tim. It says, here's the headline, ready? Investors fear long stretch of calm in markets can't last. With stock indexes at record highs, they say market volatility has been exceptionally low. What do you make of that, Tim? Give me, with all this calm, how nervous should I be, if at all?
Well, it's been an incredible run, and on average, right now we're hitting a new all-time high every 4 days on the S&P 500 this year. That is significant, and this is actually the number one conversation we're having with our advisors right now. Everybody's getting a little bit nervous.
So even though it's all good, there's this undercurrent of some nervousness.
It feels like that, and what we continue to remind our advisors is that the all-time high is not a catalyst for a sell-off. Never has been. Never will be. In fact, quite the opposite. It tends to be a very good time to be invested in the equity market. If you look at all-time highs historically, the average 12-month return that we see after that all-time high is right around 12%. 77% of the time, we're positive. Okay, so that's significant. You also tend to see these all-time highs, they tend to be clustered together. So what we're seeing right now every 4 days is not abnormal. You look at the stretch from 1989 to 2000, every 9 trading days, we saw a new all-time high. 2013 to 2022, every 8 trading days. So not only is it not a catalyst to be out of the market, right? You have to be in the market. It's a good time to be invested. You got to stay in despite the concerns.
Okay, so let's take the other side of that then. Why should you be in? Besides just like things tend to go up, which they do over even. I mean, you look over the long term as well. Stocks go up, as we like to say here, kind of tongue in cheek. But what are the fundamental reasons that people should be still invested?
Well, I think the fundamental reasons are a little bit different. You'll get to that in a second. I think right now, the next 3 to 4 months, it's all going to be about this immaculate disinflation narrative. The pause is a very profitable time to be in equities. It's all about investor sentiment. Everybody gets excited. It's been all about inflation this whole time. Once you start to see some relief, once it looks like the Fed is going to get to that cut, it tends to be very profitable. And I will say that even when the fundamentals are not going to be good moving forward. If you look at the last 4 hard landings, there has been a time when short-term rates peak where it's always profitable to be in. In fact, the S&P 500 runs an average of 20% after short-term rates peak, up to 47% in some instances. So regardless of what's next, regardless of what the fundamentals might look like, regardless of what the economic outcome might be when it's all said and done, right now is very important because all investors are always focused on that disinflation narrative, but it gets a little cloudy after that 3 to 4 month stretch.
Let me ask you, Tim, if you want to stay overweight equities, is your advice then just stick with what has been working? Is that what you're telling clients? So it's large cap, it's tech, AI?
I think you have to at this point in the game for a couple of different reasons. One, we don't think the interest rate conversation is in the bag like the market has it priced in right now. So you have to be cautious on that front. I think a lot of the big tech names, the Mag 7 names, have been doing very well despite rising interest rates. I look at that subset of securities. You're up 75% since the rate hike cycle starts. Clearly, rising rates, higher rates is not an issue for these names. So you really hedge yourself from that perspective with that risk. But you also got to remember the other side, we still don't know what the end game is going to be. When we have inflation coming down, you have disinflation, right? Companies have been able to keep margins up. They've been able to keep profits high because they've been increasing prices as prices have been going up. Now that narrative is starting to shift, and you're going to have to look for other ways to protect margins, protect revenues, right? And is that layoffs that could start to have an impact on the economy? So I look at other pockets of this market. Small caps, yeah, they look cheap. They could be a good place to be if we have this soft landing, but that's not in the bag. They're going to get hit with higher rates. They're going to get hit if we see the economic downturn. So I think it's much safer to stay in those larger cap names that we've been seeing working so far.
I mean, we have seen some research that shows that the sort of premium that those names are getting, though, and that they're earning also may start to shrink here. Do you think that is a risk?
I think it's certainly a possibility longer term, especially when I look at a stock like NVIDIA. Is the assumption that they're going to keep a 70% margin moving forward? That's going to be very tricky in a society that's not monopolistic, right? So I do think you have to broaden the horizons a little bit. But in the short term, again, where you have those risks on both sides, we think you got to stick with what's been working thus far.
And Tim, I'll get you into this. One theme that's bubbling up, you're noting, is clients maybe getting a little nervous. Yeah. Another thing I'm just interested in, we are in election year, first debates coming up. Has that been kind of bubbling up too, where clients asking more about that now? And if so, what's your advice, what's your guidance?
We're starting to see it pop up more and more. Typically, when you look at 2016, 2020, the volatility spikes happens a little later in the year. So my guess is you're going to see that bubbling up in the next couple of months. But regardless, we still have clients asking. Obviously, there's going to be a lot of differences in policy. You look at traditional energy companies doing well under a Trump administration. The green energy, clean energy companies really having a little bit more of a difficult time. What we're encouraging clients to stay focused on right now is really the consistencies of what both administrations might look like. And the one thing that is consistent, like we saw over the last two terms of these presidents, is that they like to spend money, right? And in our view, that is going to keep pressure up on interest rates. And you need to be focused on that. Going to be spending. It's going to help keep the economy going, in our view. So you got to focus what's known right now. And as we get closer, we start to see what the polls look like. You're going to see more of that uncertainty, that volatility kicking up.